Welcome, everyone, to IGM's webinar series, Market Insiders, where we talk to the top investment bankers and fund managers for their views about the global credit markets. I'm Shankar Ramakrishnan, the head of US Credit and Global Market Engagement at Informa Global Markets, based in New York. Today, we will be talking about how investors react to market risks, like the ongoing Iran conflict that is already starting to have an inflationary impact and hurting the global economy. So before we proceed, just a note to our listeners, if you have any questions during the presentation, you can send them to us using the Ask a Question module on your screen. We'll try to cover as many as we can after the presentation and if the topic has not been covered. So a bit of a background, corporate credit spreads, or the premium companies pay over treasuries on new bonds, have widened from year-to-date lows. Our primary bond markets are experiencing record issuance volumes, with demand for new bonds remaining robust despite concerns about the inflationary impact of the Iran conflict, the interest rate direction, cracks in private credit, and job losses due to AI disruption. Are investors overlooking contagion risks? Should they hedge their positions? How are they protecting their portfolios? So these critical questions will be addressed by Steve Boothe, head of Global Investment Grade and Portfolio Manager in Rowe Price's Fixed Income Division. Welcome, Steve.
Thank you, and thank you for the enthusiastic welcome. I felt like I was coming home and greeted by my two children, so that was fantastic. Thank you.
That's fantastic. Okay, so for a brief bio, Steve has nearly 30 years of financial market experience. He joined T. Rowe Price in 1999 as a credit research analyst. That's fantastic. And now serves on multiple investment advisory committees, including the Corporate Income Fund, Global Multi-Sector Bond Fund, New Income Fund, and the Institutional International Disciplined Equity Fund. Quite a mouthful. So that's a big title, Steve. So let me kick off with the questions. Let me start with what everyone is talking about now. It's the direction of interest rates, the U.S. interest rates and globally. Where do you think rates are going at this point? Do you expect a hike, a hawkish Fed, or a hawkish, European central banks? What are you looking at? What is your view on that?
So I think it's first. Thank you for the time, and really appreciate the opportunity to engage with your audience. I think in your question you highlighted something. I don't know if it was intentional or not. Something very important, and that's the direction of travel of both the Fed and the ECB. It's worth keeping in mind that the Fed and the ECB have two distinct mandates. The Fed focuses on the labor market and inflation, whereas the ECB is more asymmetric towards inflation. And I'll come back to that point in a moment. Our current view is the general direction of travel for U.S. interest rates will be flat to lower on a going forward basis. So let's call it over a 3-month investment horizon. And why is that? Well, currently there's less than one cut priced into the market for the rest of this year, over 2026. When we think about the Fed's dual mandate, we think there are underlying conditions where the growth side or the labor market side could come under potential pressure. And this will, at the minimum, prevent the Fed from becoming overly hawkish. Over time, we think that will ultimately introduce some growth risk and some additional cuts being priced into the market. Maybe one area that we could be a little different or might think a little differently relative to the wider market is we actually view this current inflation shock or this current energy shock or oil shock as more of a aggregate demand hit as opposed to a inflation spiral or a continued or persistent uptick in inflation. What gives us that comfort? Well, you see longer term inflation expectations, whether in swap markets, break-evens, they've remained reasonably well contained during this dynamic, during the Middle Eastern conflict. Despite the fact that oil was up 30–40% at one point, longer-term inflation expectations have remained reasonably well contained. So when the market started to price in incremental hikes into forward expectations, we disagreed. We thought that was wrong. So we think there's an opportunity here to be long U.S. rates or U.S. duration on the view that as the conflict normalizes or de-escalates, you start to see realized inflation tick lower on a shorter term basis. And then growth as opposed to inflation becomes more of a focus for the Fed when they think about their dual mandate. ECB is a very different situation. The ECB by mandate is required to focus on inflation asymmetrically. So we think the opposite condition can take hold in European rates. So this is a bit unique. Like very rarely, or on occasion, but very rarely do you see this sort of dispersion in underlying monetary policy across different markets that tend to be reasonably correlated. So I would argue that within the U.S., you could pick up some incremental total return by being long U.S. rates or being long duration, and we like pairing that with being underweight or short U.S. rates, particularly as we have a much more hawkish view on inflation for the wider Eurozone economy.
Right. So you think hold or maybe a cut in the U.S., yeah? And you also mentioned de-escalation. Do you think the conflict has signs of de-escalation coming soon, or?
You're certainly starting to see some markets react as if the conflict is de-escalating. I will be the first one to admit I am not a geopolitical expert, and I try to do my best to not take a directional view on risks that I don't fully can price. But here's what we do know. We do know that the front month oil contract is well off its highs and is down another 3 to 4% today. What we do know is that the longer dated component of the oil curve, so think 3, 4, 5, 6 months out, that stopped appreciating and has started to level off. So that would suggest that some of the oil constraints or physical constraints within oil are, while they're very real and very much a risk shorter term, the market would imply that will eventually work its way out. You're starting to see other prices such as corn and wheat and other ag-based prices start to come off of their highs. So by no means are we back to a status quo, but the market is certainly becoming at the minimum a bit more relaxed about some of the potential tail risk, sort of an extended period of supply constraints. As those prices start to come off, that would seem to suggest that there's a degree of de-escalation being priced into markets. I do want to be abundantly clear. We do think there are growing supply chain frictions. There are growing supply chain issues that will be with us for a period of time, particularly as it relates to the European economy and the Eurozone economy.
So hiking rates when the economy in Europe is not doing that well, do you think that's a sound decision to make, or what do you make of that?
I think ultimately it's bearish for European domiciled risk assets. I think it's ultimately less constructive or potentially bearish for European denominated credit. I think within the Eurozone, you don't necessarily need hikes in order for risk assets to trade poorly. I think simply the lack of cuts, which would be the more appropriate policy response, could be enough to put some incremental pressure on European domiciled credit spreads.
And Steve, like when there is interest rate differentials, the choice of borrowing in different markets is also kind of dictated by that. We saw a surge of reverse Yankees early part of the year. Do you think that's kind of going to slow down if there is this changes in interest rates?
So I think it will be very issuer and very sector specific. Let's talk about the sector that everyone is pretty focused on in credit markets right now, and that's technology, right? The hyperscalers. They obviously have an enormous amount of debt that they ultimately want to place within investment grade markets. Anywhere between 180 or 200 billion will likely be priced by the mega cap hyperscalers this year in the public investment grade markets.
And that's across currencies, yeah? That's across currencies.
Across currencies, that's correct. And so there is logic to the large cap issuers to diversify their funding base across various currencies. You saw Google bring a sterling denominated deal earlier this year. They won't be the last, and I think you'll see a number of other of the mega cap tech issuers fund in other currencies as well. So that is a trend that will pick up, but I would suggest that by and large, dollars is still the preferable funding currency, particularly if you have to swap the proceeds back to dollars, which many of the technology companies will need to do. So by and large, outside of diversification purposes, I do think the majority of the issuance will remain in the dollar market. If our views around ECB policy on the go-forward basis, this will likely put upward drift on euro-denominated spreads, could potentially introduce some funding pressures to investors over there. Another reason why the dollar market could very well be the preferred funding market of choice.
Right. And like since we're talking about AI hyperscaler funding, one of the reasons they were diversifying, because there is also a capacity issue in the dollar markets, right? Like you can't issue another Verizon bond without paying incremental costs. Do you think if now this focus shifts back to dollars, we are going to see some large jumbo issuance, and does the market have the capacity to buy it? Like where will you ask for more compensation increase?
The short answer is yes. I think as the larger deals come back to market, you'll see new issue concessions grow. Right now, I think the challenge for the hyperscalers is finding that marginal clearing price, that marginal spread clearing price. Now, if they have to pay a 15, 20 basis point concession relative to the returns on that invested capital that they're expecting, they're not going to balk at that, right? They're going to take the capital and move on, and we as investors will happily harvest that new issue concession, that new issue premium, and it becomes a bit of a win-win. But as the year progresses, if we're in an environment where volatility is trending as opposed to mean reverting, you put a little upward pressure on credit spreads, not our base view, but potentially, then those concessions will have to grow. So I don't believe there's going to be a risk of these issuers finding that marginal buyer. It's really about the price.
Right. And so in a market like this, do you look to hedge volatility? Have you looked to hedge the kind of volatility we have seen in treasuries around the broader markets? And your remit is across asset classes, right? With investment grade bonds, structured finance, and all that. How do you approach markets like this in terms of volatility?
Yeah, it's a really good question. Let me answer that a couple different ways. You suggested or implied in your question using treasuries or using risk-free assets as a hedge or as a diversifier.
Right.
I would suggest, or we would suggest, that idea is a bit dated. Correlations are incredibly unstable. That historic relationship between risk assets and risk-free rates, between treasuries and credit and treasuries and equities, that historic correlation will be there from time to time, but it's not a stable correlation. So a long-winded way of saying, I think relying on being long duration or using treasuries as a structural diversifier within a credit portfolio, that's going to be a bit of a challenge going forward. And there's a number of reasons why that's the case. One of it is just the inflation environment. Inflation volatility will generate rates volatility and makes it a bit of a less useful portfolio construction tool. And also just the fact that treasuries are increasingly used, as collateral themselves, right? They're used as collateral for derivatives, other credit products, and that just adds another degree of volatility in diversification, that diversification just can't be counted on at all. And you saw that over the last 6 weeks during the escalation of the Middle Eastern conflict. So where do we get our diversification? As you alluded to, I run multi-asset strategies.
Right.
I think that is historically and on a go-forward basis will be your primary source of diversification. Whether you're diversified across credit instruments globally, owning U.S. assets, relative to European assets, relative to emerging market assets, having the ability and the willingness to invest across different macro regimes, different policy regimes, different economic cycles, offers a degree of diversification to your portfolio. We're also big believers in using structured products as well, right?
Right.
As opposed to simply harvesting a credit premium, you're also harvesting an illiquidity or a complexity premium. This also adds a degree of diversification to a credit portfolio. You can use volatility markets.
Right.
You can use optionality, synthetic indices. As we learned in 2022, sometimes the vol market doesn't exactly behave as
Right.
you would expect or hope. So that is not a structural source of diversification for our portfolios.
So do you invest a lot in derivatives like T-locks? You said it's an old strategy, but do you see other do you use CDX on high grade bonds, or is that taking money away? Right.
Yes, we will use the synthetic products. The synthetic beta products are very useful instruments just for managing the overall credit beta of your portfolio higher and lower. So you have your long positioning, your long risk positioning to liquid products. So you can very easily move the overall beta of your portfolio higher or lower without having to trade the cash book, right? The bonds you hold in your cash book are there for a reason, and you don't want to trade the cash side of the portfolio simply because you're worried about mark-to-market volatility. That's where the synthetic products can be a useful portfolio construction tool.
And in terms of cash holdings, do you think it's higher, lower compared to before? Like cash is invested, but in risk-free assets, I guess. But is that is that a change because of volatility?
It is. I would say, we came into this year with cash balances and risk levels at relatively low end of recent history, and that's really just a function of the market opportunity set. Our cash balances remain reasonably elevated despite the fact that we have deployed risk into this market over the last couple of weeks. But yes, I think simply holding cash, cash for the first time in 15, 20 years actually has a positive yield to it. And so and while it doesn't exactly serve as a diversifier because it doesn't go up when other things go down, but it is a liquid instrument that can be part of your portfolio construction more so today than history.
So now let me come to the issue about, contagion risk. You said tail risk are not as bad at this point, but then we are seeing headlines every day about private credit and gating, not gating, people trying to withdraw. There is risk of defaults increasing and people questioning all these the portfolios and the ratings on them. Do you see a financial contagion risk from private credit boiling over? It's almost so. I covered the markets when before the subprime crisis, and so I get very apprehensive about these kind of headlines. What do you make of it?
So maybe I'll use the subprime sort of comparison for a moment. What made the subprime cycle more pernicious than others was this idea that you had perceived risk-free assets, AAA assets, AAA mortgages that at the end of the day were not AAA, right? And that's what really makes a true systemic issue, right? Is when you have a high-quality asset or high-quality collateral that you think is borderline risk-free or close to risk-free or cash-like, and suddenly is not. Right. And that creates a deleveraging cycle that ultimately turns into a more systemic issue. You don't have that with private credit, right? There's not a packaged, private credit product that has a AAA rating on it. And I know some people will respond, well, that sounds like a CLO. That's very different.
Right.
So you really don't have this really high quality cash-like instrument that's really private credit in disguise.
Right.
But I will say this, and when you think about credit investing, there's really three aspects of credit investing that's true, whether it's private, public, structured, EM, DM. Right. Credit is inherently cyclical. Right? That's why we call it a credit cycle.
Right.
And so it's not a constant, it's not a steady type of product, right? It is inherently path dependent, right. And that path is dependent on a number of different factors: underwriting, liquidity, global economy, U.S. economy, et cetera. So we sometimes tend to forget that credit is a very cyclical asset class. Right. Credit is very similar to really just being short a put option, right? So you collect a premium, and you're short a number of different options. You're short firm assets, you're short liquidity, you're short, a put on the economy. That's your payout. And again, it doesn't matter if it's private or public credit. That's the same. Right. And the other aspect of credit, and this is where there's some truth to this cockroach idea, that it is inherently interconnected, right? If your supplier goes bankrupt and you can no longer source an input, puts pressure on your business, that creates a credit issue for you. So there's a degree of interconnectedness within credit markets. All of those things are true, whether it's private or public credit. And so when I'm asked if there is contagion risk or if there's a private credit cycle, well, yes, of course there is, because it's still credit. Like we haven't diversified away or solved for solvency risk. We haven't solved for asset quality. We haven't solved for excess leverage or decelerating EBITDA. So with that as a framework, you can easily reach the conclusion that yes, there will ultimately be contagion risk as the cycle continues to progress and mature. But I feel reasonably comfortable saying that the cycle will be no more pernicious than what we've seen historically. Right. It'll just be in a slightly different flavor or a slightly different wrapping, so to speak.
Right. So how do you invest around something like this? If that's the view, how do you invest more in assets which are higher quality in that case or things which you can see versus what you can't?
So I think what we're ultimately where cycles tend to become a bit more pernicious or contagious when you start to hit the refinancing window. And so, rule number one is just investing in credits that you're very comfortable or refinanceable, right? Regardless of the underlying conditions. So that's one aspect of really minimizing your exposure to private credit. Understanding your BDC exposure or understanding your links to the BDC sector is another aspect to it. Understanding the investor base, right? If there's a widely held allocation to private credit and those particular investors hold other liquid assets, well, chances are those liquid assets become their funding vehicles. So understanding that dynamic or understanding that flow aspect is important to keep in mind when constructing a credit portfolio. Right.
Thank you. And I wanted to talk about credit spreads, which you alluded to earlier. Like, they are barely widening, right? High grade, high yield spreads are barely widening. They're still like 10 basis points away from the lows. Yeah. Where do you see them? And why is it so technically tight? This don't seem to budge at all, right? Like it's.
So I'll start with the last question for why does credit seem to be this almost indestructible force? Right. At least at the index level, there is a lot more going on under the surface. Right. But you're absolutely right. At a headline index level, IG spreads are around 80 over. We're approximately 10 off the tights, despite what we've gone through over the last 6 weeks. I think you have a number of factors that are supporting credit spreads at the index level, and this applies to high yield as well, both high yield and investment grade. One, we've been running 5, 6, 7% budget deficits in the U.S. for several years now.
Right.
So you have incredibly easy fiscal policy. What maybe gets overlooked about fiscal policy is that the federal government's deficit is somebody else's surplus, and that surplus is making its way into the private sector and specifically into corporate America. So the right way to think about that is that you're essentially getting a transfer of value from the federal government to public credit investors. That goes directly to support credit quality. So that's a bigger macro reason why credit quality and as a result spreads have been relatively robust.
Which is what people call it liquidity, yeah? Liquidity in the market.
Exactly, exactly. And also think about some of the tax policy over the years, where you're functionally subsidizing investment, that directly goes into, cash flow statements, which filters into balance sheet strength, filters into corporate profits. There's a reason why corporate profitability is at all-time highs and remains, really just stuck there. And a lot of that is from the fiscal transfers. We are living in a yield environment that a lot of us haven't seen in 10 or 15 years. Combine that with the demographic situation in the U.S., there's a structural demand for yield. There's structural demand for high-quality yielding assets. So really that just provides a constant flow into the asset class. One other aspect that I think goes a little underappreciated, and this is something that we spend a lot of time on, access to credit, how a typical retail investor can access the market and participate in the market is radically different today than what it was 15 years ago. The ETF ecosystem, which is approximately 15% of the market at this point, approximately 20 in some, that incremental access is incremental demand, and that's coming in usually through a passive product, and they're just buying, They're not doing relative value work, they're not doing fundamental work. That creates just another yet a structural bid to the market, to indices, which is keeping headline downward pressure on credit spreads.
And you said, but the real story within these indices is different. Because there are some sectors doing better than others, I guess, or some rating bands, I guess.
Absolutely. There's certainly a bit more dispersion under the hood than maybe that goes appreciated at the headline index level. The most obvious one is tech and hyperscalers and anything affiliated with AI. You have certainly seen a degree of decompression of specific hyperscalers, specific software companies, both relative to the wider sector, but also relative to their implied ratings. So what that would suggest is that we are entering a period where credit quality will start to erode. You will start to see more downgrades and upgrades. In fact, that's already starting. And that will just contribute to additional dispersion and, quite candidly, the opportunity to add relative value to an active portfolio. That trend is going to continue to persist.
So that comes to my next question. Like, how do you differentiate between assets? Like, what are the ones which you like at this point and the ones which you think are struggling a bit or could struggle later? Any sectors?
From a sector perspective, actually not to deviate, I'll come back to technology, but actually one of our more higher conviction structural overweights in the portfolio is the energy sector, and completely unrelated to the recent acceleration in the oil price. This is a sector that went through a pretty aggressive cycle, both in 16, 17, and then during COVID. Extreme balance sheet discipline. On top of that, there's going to be some consolidation. So a very credit-friendly outlook, or a very credit-friendly capital allocation policy with valuations that still offer incremental carry in and above the wider benchmark. So we think there's some opportunity to add alpha within the energy sector. We do like components of the technology sector. We do think some of the investment-grade software companies are mispriced. The market seems to have created or front-run an AI narrative that these businesses are going away much more rapidly than is in reality.
Right.
It's really difficult to really just replace your HR software, for example, with an AI stack overnight.
Right.
So the market really, because of some of the equity volatility, put too much incremental pressure on some components of the software sector. So we think there's some opportunity to add alpha there as well. There's also some opportunity within the hyperscaler space as well. Now you are going to fight supply, which keeps us, a bit more currently defensive. But there will be winners and losers within the wider technology space. That'll give you some opportunity to add some active performance.
Which is comes to my question about the market expectation that all this leverage building by the AI hyperscalers might not justify the returns or potential returns. Do you believe they're over leveraging at this point on a technology yet to be proven to generate money, or how do you look at that?
Yeah, it's a good question. It's the right question. It's a difficult question to answer. I think we are pretty constructive on the AI ecosystem overall.
Right.
And so while maybe some of the returns that are expected to be generated aren't necessarily realized, you don't need sort of some of these really high ROE projections to be realized for the credits to work, right? So we think relative to the CapEx spending and the anticipated returns, relative to the amount of leverage being put on today, based off of what we know, we think the hyperscalers will be fine. The issue with hyperscaler credit right now is more of a supply and a technical issue, as opposed to we will not generate enough returns to pay back the capital, to pay back the debt. Now, within other segments, becomes a bit more challenging, right? I don't think you can make that statement about the data center segment as a whole, for example. You need to be very, very cautious around not just the underlying tenants, but the technology, the access to energy, a whole host of other factors that can go into sort of the underlying credit quality of the data center. That's a bit more of a credit picker, or a bit more of a challenging area. I suggest there will be stress in that area over time, but that's more of a multi-year process.
So even in structured finance, like on the data center ABS deals, we are seeing some sort of pricing adjustment there, like spreads are widening. Are you seeing that playing out, what you said about data centers? Do you see people differentiating between different kinds of credits?
Yeah, they'll differentiate between location, like geography, where the data center is located. Obviously, the tenant. If you're sort of have a multi-lease framework relative to partnering with Microsoft, that's you'll see some differentiating dispersion in pricing. Access to energy, utility, et cetera. There's a number of different factors that are really going into how data center credit is being priced. So there's a high level of dispersion across that particular segment, across both public data center, structured, and even within the CMBS market as well.
Right, interesting. And one more thing I wanted to, like, structured finance market, at least the way I look at it, is kind of reflects the real economy a bit, right? Because it's securitizing student loans and auto loans and the stuff which we use on a day-to-day basis. The spreads are widening a lot in structured finance. The supply has gone down the last few weeks. Are they playing out a whole idea that inflationary pressures will start affecting, subprime borrowers or people with low credit scores? Do you see that correlation as yet, or is it too early?
It's too early. You've seen pockets of volatility within subprime components of the market. Let's pick on subprime auto, for example. There was a period where you had a degree of repricing as there were some growing concerns around underlying consumer credit quality. And there is some dispersion being picked up, but I would not say there's been a widespread repricing of subprime credit more broadly. There's going to be some specific tranches of specific issuers that are coming under pressure. But by and large, you're not really seeing that consumer credit pressure or credit quality erosion hit the subprime component of structured credit wide scale.
Right. And so now I'm going to come to you with a pet question, because I've been covering the bond markets for a long time. Why does it still operate on phone calls and chats? And how does that, and how do you, as an investor, deal with it on a day-to-day basis?
So I will say there are fewer phone calls and fewer chats.
Oh,
On a day-to-day basis, roughly 50% of investment grade volumes are actually electronically traded. So using an electronic platform, you don't pick up a phone, you're not really talking to a dealer on the other side. That happens roughly for 50% of volumes. And in the high yield market, it's about 35%. So there is less, pick up the phone and call your friendly Bank of America salesperson to ask them to work 20 to take 5. That doesn't happen quite as often. So the bond market is increasingly becoming very technology heavy.
right.
There's recently not just electronic platforms, but there's increasingly technology that we use that helps us price risk, but price risk not on just a one-off credit basis, but price it as an entire portfolio.
Oh.
Generally speaking, outside of idiosyncratic credits that you're either buying or selling within your portfolio,
Right.
generally the vast majority of the trading you do is flow oriented. And so, technology has allowed us, and the proliferation of a number of the ecosystem has allowed us to price risk more on a block basis. You can price risk on a couple $100 million portfolio spread across 100 and 150 credits pretty quickly and pretty efficiently.
Right.
So we are coming out of the dark ages to some extent.
On the primary markets as well, the
Primary is still, that's a fair point. There's still a degree of direct communication on the primary markets as well. But I will say the time to market has shrunk, particularly for regular way issuers. And that's been a function of just improved technology and efficiencies.
Right. And, like one of the things which I noticed while covering the bond markets were like the syndicates were accelerating the book building, right? Like they would jump from IPTs to launch without going through guidance, or, they were doing deals much quicker. How do you see that as an investor? Does it give you enough time to look at things, or are they rushing it too much? How do you view that?
Yeah, it does. We do have time to get our orders in and make our decision, but we are doing it under a much more compressed time frame. And on a day where you have a dozen new issues to look at, it obviously becomes a bit of a time crunch. But I think the question is why is that happening? Why are books being built so quickly, and why are orders in so immediately, and funding can be done, And my personal view here is that I think a large component of that is due to the growth of systematic and index strategies. As index strategies become a much larger component of the market, they're obviously going to be in for nearly every deal that is index eligible. They put their orders in, and they don't have to make a relative value decision. They don't have to make a fundamental decision. It's very mechanical. And as those strategies grow, they take up a larger component of the book, and you don't have to keep the book open, because once you've gotten to the funding you need at the price level, it's done. So I think that market structural evolution where there's been more indexation and less active has contributed to that compressed time frame.
And order book inflation, like people putting in bigger orders so that they get a better allocation, is that still an issue, or how do you look at it?
We at T. Rowe Price don't over-index or over-inflate our order book, so anything that happens is outside of our walls.
Okay, so on the next quarter, what are the red flags we should look for as we go into the next quarter? Like, what are the things as an investor, what are you looking at, and how does it change the way you've constructed your portfolio at this point?
So a couple things that I think investors should be mindful of. I'll go back to how I started the conversation. I think growth is likely the more relevant risk for the next quarter, as opposed to accelerating inflation. And what you really mean by that is the labor market. The labor market is at a what I would say a peak fragility right now.
Right.
And so if you get some erosion of the labor market, that becomes problematic for risk assets. But if you get some stabilization or improvement, then risk will continue to trade well. And what I would suggest watching is less about the aggregate non-farm payroll number or the unemployment rate, but focus more on some of the internals. Focus on hirings and firings. Focus on labor market churn. Focus on the wage delta between new job getters and leavers and things like that. There's some really valuable information content within the internals of the labor market report to give you an idea of labor market dynamism.
Right.
And that's what's really important, right? That's as if dynamism returns to the labor market, then growth will inflect positively and risk assets will remain well supported. We're paying very close attention to supply chain frictions coming out of the Middle Eastern conflict, particularly what that means for Asia and Europe. This isn't about cost. This is about access, right? And so I think anything that evidence grows that you have supply shortages or loss of access to particular inputs is obviously highly problematic. Specific to credit, we're obviously paying very close attention to the supply dynamics, particularly around the technology sector. We're obviously paying very close attention to the BDC sector and what this means for flows in that area. Insurance is also another space to watch as well. Not that we're overly concerned about insurance credit quality, but if insurance growth were to slow, insurance does provide a flow or a positive support into credit more broadly. So if their growth were to slow, then that could be somewhat of a technical headwind or a problem for credit as well. But I would say by and large, working under the assumption that the path of the conflict is one of de-escalation.
Right.
We can enter a window here where we get some stability, volatility can remain reasonably tame, and risk will trade reasonably well for a quarter here.
Right. And Steve, this is a personal question to you. So you joined Rowe Price as a credit research analyst, and now you've grown so much into the role with a long title. What is your advice to all those graduates or people doing finance looking to become the next Steve Boothe?
Well, I don't know if I encourage anyone to be the next Steve Boothe, but I think one bit of advice that I give individuals that I try to stay true to myself is read a lot and then read more. And I don't mean just read newspapers or read sort of Instagram or whatever it is where people get their news. I mean, read academic papers, right? Read content that is a bit differentiated relative to what you do. Whenever I have associates or interns asking me for book recommendations, there's two that I always recommend. One is a book by Steve Keen called Debunking Economics, right. And really it's just it's sort of a couple hundred pages in an attempt to reject neoclassical economics. And the gist of it is that neoclassical economics looks great on paper, but it doesn't really work in the real world. And another book that I recommend, that I highly recommend to younger associates, is Understanding Modern Money by Randy Ray. It really gives you an understanding of what stock and flow and balance sheet impacts have when you think about the intersection of fiscal and monetary policy. So my guidance is really to just try to consume as much sort of information via books, papers, et cetera, as possible.
Keep learning, basically. That's what I'm doing all my years. Keep
Never
learning.
Stop.
And
Never
so
stop.
Thank you for all that, Steve. That's all we have time for, I'm afraid. And thank you very much. It's always great to talk to you. And so many different perspectives is just amazing. But if you have any feedback on today's webinar or any recommendations for future webinars, please do complete a short survey at the end of this webinar. It should flash up on your screen. It has been a pleasure bringing you this webinar, so do keep a lookout on informaconnect.com/IGM for the recording of this, other webinars, and new analyst insights. If you like to find out more about IGM services, get a free trial. And thank you very much, Steve, and goodbye. Signing off. Thank you. Thank you, sir.
Thank you.